Hello, friends, and welcome to this amazing webinar on where our equity markets headed and what MFDs need to know. Friends, the last 2 years has not been so good for equity market as markets remain volatile and delivered negative or flat returns. However, one surprising and unusual thing is that the market has not corrected so much despite geopolitical tension and heightened volatility. To give you a much needed clarity on where the markets are headed today, we have invited Mayur Patel, fund manager listed equity at 361 Mutual Fund. Mayur has over 20 years of experience, including 18 years in investment research and management field. He currently manages firm's flagship scheme, 361 Focused Fund and 361 Flexi Cap Fund. So without wasting time, let me welcome Mayur. Mayur, welcome to the show.
Thanks, Nishad. Thanks for the opportunity.
I
Hi,
hope
everyone.
well. I hope you're doing well.
Excellent. I'm doing fine.
And
Thanks.
many congratulations on completing 3 years of FlexiCap Fund.
Thank you so much, Nishad. Yeah, we have just completed 3 years,
Yeah,
first 3 years of Flexi Cap Fund.
yeah. Great achievement. So, Mayur, so my first question is must be on everyone's mind today. So, after a dream bull run, equity markets have largely remained flat, delivering little to no return over the last 2 years, as you know that. So, at the same time, despite significant volatility, we have not seen any meaningful correction. So I wanted to understand that what lies ahead for equity market. Will it correct? Will it go up? What is your take?
I'm clearly bullish on the market at this point of time and calling out two things. One, FI flows will pick up significantly over next 3 to 4 months' time as rupee stabilizes. Two, corporate earnings will go through an upgrade cycle as we enter the second half of the year. So basically, I'm hopeful of, like most of us, of West Asia conflict getting over soon, and we are almost at the fag end of very difficult to predict, but that's the hope that this will get over because none of the involved parties can stretch it for long, right? And clearly, in that camp, of believing that crude price is likely to come down to $70 and below, and that will lead to discretionary consumption to pick up, commercial vehicle cycle to come back in force, and private capex will again gain momentum. Joining all the dots, credit growth is already picking up, bounced back from 9% to 16-17%. FCNRB and the other related initiatives taken by RBI would garner at least 80 to 90 billion dollars of foreign flows into fixed income, and that should add on to liquidity and should further propel credit growth, right? So the setup is very clear for a comprehensive rally, especially when your valuation entry point is around 3 times price to book. So Nifty valuation after, like you mentioned, after consolidating for 2 years with with negative returns, the entry point is 3 times price to book, which is
Mm,
like very close to the 20-year median
mm.
of Nifty price to book valuation history, right? So the entry point is attractive, and the setup is very, compelling to believe that there is a very comprehensive rally ahead as we get into the second half of the year.
So very rightly put, Mayur. So you have mentioned some of the opportunities, but what are some key risks from here on for the markets?
Two critical factors of risk would be elongated West Asia conflict,
Mm,
and that can keep crude price elevated for long periods of time. So it doesn't matter whether crude is at 100, 120, more than the value of crude price. What's more important is the duration. If
mm,
crude price is above 100 for 2 months, 3 months, it doesn't matter. Whether it's 120 or 100 doesn't matter. It's very transitory in nature. But if it is more than 100 for 12 months, definitely it impacts the entire macro condition.
mm,
And crude price is one macro factor which hits almost every macro factors which are relevant for the Indian economy, right from current account deficit to capital flows to BOP, either directly or indirectly, inflation, uh, currency, and eventually growth, right? So that's the very big risk to monitor. And second is, monsoons. So weaker than expected monsoons can, disrupt the rally in the market whenever it starts.
Got it, got it. So, but I think this year is the India will have El Nino impact, and we are seeing the monsoon are lower than the average. So,
I
do
would say
you have?
there are a lot of concerns, say a month back,
Hmm.
but now we are seeing some signs of some positive signs. So let's keep our fingers crossed. If the deficit is in the range of 5-10%, I think that can be managed. But if it is much wider than that, then it's a problem.
Got it, got it. So, Mayur, what is your assessment of valuation across large, mid, and small cap segment? And where do you see the best risk reward opportunity today?
So small caps currently offers the best risk reward. If you just look at the small cap index, the price to book, and it has corrected from the peak, the froth is out, right? And whereas mid caps are still somewhat expensive as compared to its own past,
Hmm.
large caps are in good value zone. But there are very clear growth concerns related to quite a few nifty names. Right? So that's the pecking order. Small caps and large caps are in good value zone. Small caps do have more growth assigned to them, and large caps one need to be selective. Whereas mid caps one need to be very cautious because of expensive valuations.
Hmm. Okay. So, Mayur, flexi cap is one of the most popular category in the mutual fund industry today. So, I wanted to understand that what opportunities do flexi cap funds offer that large, mid, and small cap segments do not?
So a large cap fund is mandated to invest at least 80% in large cap segment. Right? Small cap and mid cap funds are mandated to invest at least 65% in their individual market cap segment, irrespective of the risk reward. Right? So early part of 2025, clearly small caps were in a frothy zone. Valuations were really expensive. Right? But a small cap fund has to invest 65% in that segment. That's the case with other two, market cap segment categories. That irrespective of the risk reward, you are bucketed in a particular market cap segment, right? Which is not always favorable from the end investor's point of view. Flexi cap fund, if it is truly managed, true to the label, right? It can invest in large cap, mid cap, small cap in any proportion. Wherever
Yes.
the fund manager sees the alpha potential and the risk rewards are right, that's where the more money has to be allocated, not by some market cap limits. So there are no regulatory constraints in the flexi cap category, and that's what it gives it an upper hand as compared to other, you know, uh, market cap segment categories.
Okay. But despite this, we have seen that majority of flexi cap funds have large cap biases.
So I cannot comment on individual funds. I also got this, comment that there are a lot of flexi cap funds are large cap biased. But I can just talk about ourselves. It depends on what kind of constraint a particular fund has. But we are running the flexi cap fund purely as a flexi cap fund. That's a one needs to be true to the label. If you look at our large cap component, has gone down to as low as 40% and it has gone up to as high as 62%, right?
Hmm.
So, and if you look at the mix between large, mid, and small, also, it has been really dynamic.
Hmm.
Since there are no constraints, we have to think in terms of where our research bottom up process is giving us the conviction to put more money rather than anything else, right? So I can just comment on that a FlexiCap fund truly manages FlexiCap will have lots of advantages in terms of capturing right opportunities at right risk rewards.
Great, great response, Mayur. So, Mayur, my next question is to you is about flexi cap funds. So, flexi cap commands highest share of assets across all equity fund category, as you know. So, it is the highest across all category of fund currently. So, what are the three things that has contributed for its popularity?
first factor is flexibility, which I've already covered. That so market has become more and more dynamic. There are lots of disruptions happening. Like in our 3 years of Flexi Cap Fund, which I'm managing, right, and I've been managing our focus fund for almost 7 years. We have seen COVID. We have seen sharp bull rallies. We have seen massive correction in small and mid caps and things like that, right? So the flexi cap fund run in a proper flexi cap way can rotate money to right risk reward pockets, right, instead of getting constrained by other factors. And that's what gives it an upper hand. Number two, it's a one stop product. If somebody wants to, an investor is keen to have a diversified investment, right? So one product gives you exposure to large cap, mid cap, and small cap, and which is dynamically, balanced based on the fund manager's view on individual market cap segments and bottom up opportunities, right? So instead of investors breaking their own head and trying to allocate money between a large cap fund, a mid cap fund, and a small cap fund, they can opt to put that money in a flexi cap fund doing the same job, right? So instead of investing in three funds, you can invest in a one good flexi cap fund. And last but not the least, this category has sailed through multiple stress events and created a good track record, and which has built some amount of trust in the investor community. So to become a core portfolio product rather than a satellite bet.
Got it, got it. So, Mayur, flexi cap funds are very similar to multi cap funds and ELSs. So, what additional benefits can investors get from flexi cap funds that aren't available in the multi cap and ELS structure?
See, actually, it's different. A multi-cap fund is mandated to invest 25% in large cap, 25% in mid cap, 25% in small cap. Again, I covered this point earlier, irrespective of the risk reward, irrespective of the fund manager's view and things like that, right? That constraint is not there in the flexi cap side. A flexi cap fund can have 100% small cap or mid cap or large cap or mix of all the three in whatever proportion is optimal from the returns point of view, right? That's the biggest difference between multi-cap and a flexi-cap fund. And if it is run in an appropriate way, right? So clearly, flexi-cap and multi-cap are not comparable. Different people can have different preference. One can opt that no, I don't want to take any fund manager's view on a particular market cap segment and would like to have a very disciplined 25, 25, 25 kind of allocation. For that investor, multi-cap is a good product. But somebody who wants the best risk reward, taking that bet on that fund manager or the AMC, FlexiCap does a great job, right? ELSS has a 3-year lock-in with a tax deduction benefit, but as the new tax regime picks up, that attractiveness goes down. So I think FlexiCap as a category clearly has a higher merit than these two, in my view.
Okay. So before moving ahead, I would request all the participants to post their questions in Q&A so that we can simultaneously take some of the audience questions. So Mayur, my next question is about 361 FlexiCap Fund. So despite being a new entrant, the fund has delivered good returns. In fact, the fund has a track record of over 3 years and it has outperformed the benchmark by almost 3%. So, what strategies have you deployed to generate this alpha, and what will drive it going forward?
Yeah. So 3% plus alpha is in the regular scheme as we completed 3 years, and direct scheme would be slightly more. But basically, our bottom-up approach and a market cap agnostic way of investing, and through our blended framework, which is the SCDV framework. So basically, you have a mix of growth stocks, value stocks, and defensive stocks at all points of time. The allocation can change, but there's always a mix. So you're not isolated into 100% growth stocks or 100% value stocks, right? And that can lead to, some good years of performance and could be some extreme underperformance also. So this blend philosophy is something unique to us. and the bottom-up approach has worked really well. In terms of sectors, we were pretty bullish on the manufacturing story in the country. And our picks in industrial segment, playing the renewable theme, defense, the entire manufacturing make in India, which also includes power, T&D, and some of the adjacent categories. Really, electronics manufacturing really created a good amount of value for us. So that played out really well. And selecting stocks across the four quadrants of our framework, which is like secular growth companies, cyclical companies, defensive companies, and having a limited exposure in value traps. So that's what we call it as a SCDV. But in simple terms, it gives you a good mix of growth, value, and defensives, right? So once you have a very high focus on bottom up, and your bottom up ideas are getting captured in all the four buckets of the market, even in a 30-40 stock portfolio, it gives a good diversification because you are invested in different parts of the market, right?
Got
So
it.
that framework-based investing helped us to have a very disciplined approach of capital allocation in different parts of the market at all points of time, right? So that's what has helped us. And going forward also, this is the approach which I'm going to follow.
Okay. So Mayur, I was going through the fund fact sheet and I found that the fund has very high exposure to financial services, capital goods. In fact, almost 50% of the total portfolio come from these two sectors. So why are you so bullish on these two sectors?
Yes, we are positive on the financials, for example, to start off. Financials, it forms around 30% of the benchmark. So we have around 2-3% overweight across different schemes. And we continue to remain positive because private banks' valuations are very reasonable, right? System credit growth has bounced from 9% at the lows to now 16 to 17%, right? Now it's going to further strengthen as FCNRB deposits will come through. Higher liquidity will also cushion more deposit growth, which is a current area of pain point, right? So reasonable valuation, liquidity going up, credit growth going up, credit cost under control. Margin pressure was a pain point till now. Even in this quarter, we saw margin pressures. But I think we are coming to the fag end of that trajectory of margin pressure. So joining all the dots, we remain positive on the financials, which includes NBFCs. NBFCs are slightly more expensive than private banks, but they are the frontline growth proxies, right? Big beneficiary of the commercial vehicle picking up, discretionary consumption picking up, and overall resilience in the economy, right? So we continue to have a positive stance on the financials. Industrial is another
Mm.
pocket of overweight, and I already explained that if I had to define India's opportunity over next one decade in one line, it would be manufacturing. 20 years back, I would have answered the same question or on the same point, I would have said consumption. India is a consumption story, but now India is a manufacturing story. Next 10 years is a manufacturing, right? So defense has already played out to a great extent. Renewables is a manufacturing story in making. Power T&D is a manufacturing story in making, right? Semiconductor is going to pick up a very early stage. Electronics manufacturing is growing at an exponential growth rate. These are all pockets, and there are more coming through, like AI data center is going to drive, I think at least 13 to 14 gigawatt of AI data centers are likely to come on stream over next 5 to 7 years' time, which should entail more than 10 lakh crores of capex, right? So that will drive demand for cables and wires, for power T&D equipments, for DG sets, and many other equipment, right? So industrial, we continue to like the theme. Some stocks have become expensive. We are cognizant of it. So we would continue to look for interesting ideas to play this theme at the right risk rewards.
So the next decade will be for manufacturing.
Manufacturing, yeah.
Very, very rightly put. So also another observation is about the large cap exposure. So 361 Flexi Cap Fund has close to 51% exposure to large cap companies. So is this a large cap bias or what's the reason behind this?
Sorry. Uh, so actually, it's the other way around. Our large cap exposure is one of the lowest in the flexi cap category, right? Like you only mentioned that people complain that flexi cap funds have become more
Large cap.
capish, but that's not the case with us. If you look at the history since the time last 3 years, our large cap, mid cap, small cap, that mix has been really dynamic. The large cap exposure has gone down to 38, 40%. It has gone up to 62% and things like that. So in 2025, first half of the 2025, we did see froth getting built in the valuations of small and mid caps, right? And we did increase large caps at that point of time by cutting small and mid caps, right? In this year, through February and March, this correction, we were getting a lot of interesting small and mid cap ideas, more on the small cap side. And we have increased our small cap exposure over the last few months' time. So we are trying to manage this fund in a purely flexi cap way, not in a large cap way. So if that answers your question.
Got it. So we have a couple of questions coming from audience. Let's take them one by one. So Sahil Madan wants to understand whether SIF would be the better option in this war-like situation.
SIF is a different product. It has multiple products. We do also have a few SIF funds. I think the one important feature of SIF is it has a provision for going short, right? The investor need to have a different mindset. When you invest in a long short product, you're trying to have a absolute return strategy. That's what is the expectation. You're not trying to achieve alpha, beating benchmarks and things like that. So I would say SIF adds on to the investors' bouquet of funds rather than either you invest in flexi cap or in SIF, right? So that's what is my thought. It definitely helps in a choppy market because it has the short element, which reduces the market exposure. It depends on how the fund or the scheme is run, because it's open to how much you can go short, what kind of thought process the fund manager has, and things like that. So my answer to that question is it adds on to the portfolio mix and helps to manage the risk better at the overall portfolio level of the investor rather than it replaces any of the mainstream MF funds.
Got it, got it. So Mayur, another attendee wants to understand what would be your outlook on gold, especially in 6 to 1 year time frame, medium term outlook.
Honest answer, I'm not an expert on commodities, but directionally, I think whatever little knowledge I have, because I have a separate team investing for our multi-asset fund, we have almost 30% in gold and silver, and the team has done a good work in terms of booking silver at a good point of time and things like that, managing it well. But what I understand from my team is directionally gold has a very secular trajectory going forward over next 3 to 4 years' time. As more and more it is perceived as a safe haven. It was always perceived as a safe haven, but it is getting more and more importance in terms of the central banks, capital allocation, decision making, and things like that, right? And there are other fundamental demand supply factors, but directionally, I am positive. It has been a very strong run. Then we have seen a correction, but without giving any precise view on the short-term movement, I think with a 3 to 4 year view, the direction should be positive.
Acha, Nilay wants to understand what would be your view on IT software services sector, and since the valuations are attractive, whether it offers a good buying opportunity for investors.
So IT, first of all, we have been carrying a significant underweight in IT sector for last few months, right? And that has helped us. And we continue to remain cautious on the sector despite attractive valuations. Because the problem is Indian IT services, the frontline large cap players have a large part of their business which is exposed to disruption. Overall, these players are going to see 3 to 4% deflation because of AI, scale up happening globally, right? So they need to transform on an urgent basis, and it's difficult to transform such a huge business models overnight, right? So they are going to face growth concerns for sure in the near term. Valuations are cheap. Dividend yields are giving very strong support, but we need to see how and what kind of M&A they can do, what kind of skill sets they can acquire, to deal with this AI related 3 to 4% deflation, which is going to happen. So till I see more, transformation happening, I would not jump very quickly unless you see one more leg of sharp valuation correction, which makes it very compelling.
Okay. So currently you are in wait and watch mode.
And continue to have an underweight as of now, significant underweight.
Got it. Got it. And Farhad wants to understand if a client has well diversified portfolio in equity mutual fund across categories, and let's say if he wants to take exposure to small and medium mid cap segment, so whether you would recommend him to look at X top 100 hybrid SIS?
No, it's a very pertinent point or question, right? We have recently launched our Dyna SIF X Top 100, right? It is basically a small and mid cap fund
Mm,
uh, with the provision to go for some shorts, right? So as per mandate, it needs to invest 65% plus into X top 100 outside the top 100 large, stocks, right? So basically, a small and mid cap component would be 65% plus, right? So currently, we have been saying that we intend to keep it in that 70 to 80% small and mid caps as of now. It can change in future, but that's a current thought. And some large caps where we have bottom up ideas coming in the large caps. It also gives some liquidity comfort in case of any events. And we will go for fundamental shorts as of now, right? Where there is a sell, very strong research driven sell view, then you can go for shorts, right? But predominantly it would be more like a big long only small and mid cap portion, a small part of large cap portion, and certain shorts, right? So that gives you, it's basically a small and mid cap fund with a lot of flexibility, I would say. So if you want to invest in a small and mid cap fund with these layers, I think it's a great product, right? So if say today small caps are looking more attractive, mid caps are expensive, right? So a fund manager can take a call of having more small caps in the
mm,
mix.
mm.
Maybe at some point of time, small caps get into a frothy zone. Mid caps are reasonably priced. You can increase your mid caps. Instead of getting bucketed in a mid cap fund or a small cap fund, this gives you a much more flexibility to invest across small and mid caps. Right. So I think it's a good product.
Which product would be good, SIF route or AIF route?
So SIF gives you the tax benefit, right? And if the same product is there, then obviously you go with a more tax efficient product.
Of course. And Mayur, now coming back to the Flexi Cap Fund. So there are several Flexi Cap Fund with established track records in the market. So why should MFDs look at recommending your fund to their client? What differentiates your strategy?
So key differentiating factors are we are very much bottom up focused in terms of our investing approach. Market cap agnostic, we have no bias towards any market cap, right? Our philosophy is blend. So no bias towards any market cap, no bias towards any market factor, whether it's growth, value, or quality, and things like that, right? So market cap agnostic, factor agnostic to a great extent, and bottom up approach with a very strong inclination to embrace technology. We have been constantly working to integrate AI, to reduce the data crunching job and help us take more analytical decisions in a better way, reduce our mistakes, to do forensic analysis in a quick way using technology, to do fraud analysis. And there are a lot of things which we are trying to integrate. It's work in progress, but is giving us great results, right? So technology absorption, market cap agnostic, a blend investment philosophy,
Hmm.
which basically investing across growth, value, and defensives, which we call it as a SCDV framework: secular, cyclical, defensives, and value traps, right? That's what is the differentiating factor. And no constraints. Our flexi cap, as I mentioned, you can go significantly low on the large cap side, significantly high on the small cap side, can have a modest exposure in mid cap. At some point of time, it can rise. Right? That's what a flexi cap fund is supposed to do. Right? So that differentiation is what has helped us in the first 3 years of the flexi cap fund. And we'll continue to do work in the same direction.
Mayur, you mentioned about fraud analysis. Can you throw some more light on it?
So we have quite a few processes
Mm,
when we look at a new company where as a house, if we don't know much about a company, uh, you know, there are different tools. One tool is the Benford's Law, Benford, right?
mm,
It's a very interesting tool, which basically you can upload the entire financial data, whatever you have of the company, say
mm,
10-year P&L, balance sheet, cash flow, whatever you have, just upload everything, right? And Benford's law, anyone can do a Google search and you'll get it. It's a very simple, anyone can apply it, right? It says that it has a frequency table that digit one should
mm,
appear as a first digit of all the numbers, right, in a particular data set for at least for around 31 or 32%. I exactly don't remember the frequency, but giving you an example. So for 32% of the time, digit one should appear as a first digit.
mm,
Similarly, there is a frequency given for digit 2, say 24%. I don't remember the exact number, but it's around in some 20s, right? Digit 2 should appear as a first digit for 24% of the time in the entire data set. That way it has given a frequency and it works brilliantly. We have tried to upload 1,000 companies, data, and the frequency table was very close to what Benford's law has mentioned, right? So if there is any
mm,
deviation in a particular data set, if the digit one is showing only 24% or 20% kind of, then it clearly raises eyebrows. I'm not saying it's 100% foolproof,
mm.
but I think it's very effective. And this helps us to, avoid getting trapped into a fraudulent company where if a number is fudged,
Mm.
manually somebody has changed a 10,000 crore number to an 11,000 crores or something like that. There's a high probability that Benford's law can catch that. So that's one of the fraud detection tools we deploy.
Great, great. Good to know about that. So, Mayur, my next question is about alpha generation. So, alpha generation, as you know, that has become major challenge for active fund managers. In fact, our own analysis shows that 4 out of 10 mid-cap funds and flexi-cap funds actually outperform the benchmarks. So, how do you plan to generate alpha in such a scenario?
No, so again, it comes to when you talk about a specific mid cap fund or a specific small cap category,
Yeah.
again, same points which we covered, right? You're bucketed in a mid cap segment, in a small cap segment. So when the segment is in favor, right, you continue to do well if the stock selection is good. But when you see risk rewards peaking out and you see a strong correction happening, you can't get into large caps, right? Or
Mm,
any other safe zones. You have to go through the brunt, no matter how good is your stock selection. And that's what distorts 3 year, 5 year performance at times in terms of alpha, right? So that I think that way I'm a big proponent of a highly flexible strategy. You can call it as a flexi cap or any other category where there's good amount of flexibility for an investor to reflect its for a fund manager to reflect the highest conviction with the limited constraints, right? I think that can help generate alpha. From our point of view, adding one more layer is we don't so we clearly differentiate between short-term volatility and long-term capital erosion risk, right?
mm,
So you don't shy away from embrace short-term volatility as far as there is enough justification for a very good outcome from a medium to long-term point of view on a risk-adjusted basis, right? So in simple terms, if the short-term volatility in stock price is purely because of technical factors or market factors, some macro concerns, which could be transitory in nature, right? And we are fully convinced about our investment thesis on a company and the sector opportunity. Uh,
mm,
we have good amount of tolerance to sit through. that short-term volatility. So some of these nuances we are trying to have an edge, whether it's a blended philosophy, the clear thought process around short-term volatility and long-term capital erosion risk, the market cap agnostic approach, embracing technology, and some of the tools which I mentioned. These are some of the factors which has helped us so far, in terms of generating healthy outcomes or healthy returns.
So, do you actively leverage AI for fund management?
No, that's work in progress. We have integrated quite a few AI processes in our analytical research process. As I mentioned, in the huge amount of data getting processed, there are a lot of transcripts, earning transcripts. You get half a page summaries quickly. Everything is there in our system, and you can understand. You can go through 500 pages say transcripts of 10 companies by going through half of page each, right? That's
Mm.
just a small example. So we're constantly adding more layers on the AI side, but we are a big proponent of AI becoming a core part of your investment process. You cannot avoid it.
Got it, got it, got it. And do you believe that alpha generation will continue to happen in India, or there will be a challenge going forward 10 years down the line?
Oh, I'm a big proponent. I could be biased because I'm a long only active fund manager. So I cannot, I
Mhm.
am in that camp. So, well, excuse me if I'm sounding biased, but I think there are certain factors like touch and feel of the business, right?
Mhm.
So, sitting on the desk, running AI processes, which we do, crunching data, finding out good risk rewards, you can do all of that.
Mhm.
Once you meet the promoter, the management team, the second in line, right? You have seen, you have read that this business has a very strong manufacturing mode. You
Mhm.
will not get conviction unless you see and get a touch and feel of that mode, right? So there are a lot of things like that which cannot be replaced or which is very difficult to replace. So I think there are enough pockets where active fund managers can continue to add value and create alpha for foreseeable for a long periods of time.
So, Mayu, since we are running out of time, I want to ask one last question. Given current valuation, should investors enter flexi cap funds through lump sum investment or take a staggered approach?
No, so systematic investments like SIPs are always best. There is no doubt about it, right? And in fact, if you look at our commentaries for last almost more than a year, we have been saying that given the uncertainty, higher valuations, SIPs are the best route. Long-term India story is great. At this juncture, I don't mind putting lump sum also. I see 2 years of consolidation has happened, negative returns have happened, your valuation is at 20-year median, right? And I'm taking a call that FI flows will pick up. We will enter earnings upgrade cycle in a big way as we enter second half of the year. Makes sense for lump sum investments also at this point of time.
All right, we have come to an end to this interesting session. Thank you so much, Mayur, for your valuable time and inputs.
Thanks, Nishant, and thank you so much, ladies and gentlemen, for your patient hearing and looking forward to be in touch. Thank you.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Thank you. Bye bye.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.